Look at any major city intersection. Most people are caught in an exhausting cycle of motion, working longer hours and moving faster. But behind that chaotic retail struggle, a systematic economic game is being played by the financial elite. Wealth follows the logic of the mental operating system you use to process every decision. We are repeatedly told to earn more and hustle harder. Without an update to that baseline logic, increasing your physical effort rarely changes the long-term trajectory. To scale your net worth, you have to cross 5 specific cognitive thresholds. This diagram charts the progression of your cognitive capital calibration. Diagnosing exactly where your firmware sits on this pyramid is the first requirement for breaking the direct link between your hours and your income. The first 2 levels function as fragmented, linear mindsets, controlled by defensive fear and survival mechanics. Tier 1 is the scarcity firmware. As you grow up in a household restricted by month-to-month survival, your brain hardcodes a binary view of the economy. You see money as a finite shield, and your reality filters through a single thought: I can't afford this. This creates a severe operational flaw. Even as you start generating revenue, you might still spend a $1,000 brain on a $10 manual repair, like a low-quality DIY plumbing job, just to avoid deploying capital to a professional. When the constraints of scarcity become suffocating, you step marginally outside that comfort zone and enter Tier 2, the price arbitrage firmware. You peek at the numbers, but your perspective remains fixed on nominal price tags and micro-budgeting. This geometric scale illustrates the system bug of Tier 2. You might spend 20 minutes of irreplaceable cognitive runtime driving to a different store just to save 20 cents on a bottle of water. These early tiers confine operators to a low-velocity loop because the software treats cash as a scarce resource to be hoarded, while treating finite biological time as an infinite, uncompensated commodity. Escaping the retail trap requires a cognitive rewrite. You have to move past raw pricing data and start analyzing the landscape through the geometry of value extraction. This initiates Tier 3, the value injection architecture. Your primary operating filter shifts. You stop asking about the cost and start asking the institutional question: how much is it worth? You realize that cheap inputs yield broken outputs. You eliminate spending guilt by deploying upfront capital to buy premium, high-utility tools once, rather than purchasing lower-quality goods 3 times over. That logic pulls you into Tier 4, the system growth architecture. At this stage, capital is used to engineer an automated lifestyle factory. Looking at this pipeline flowchart, you can see how a Level 4 operator handles daily logistics. By deploying bulk purchases and automated macro scripts for things like nutrition and supplies, they delete the micro-friction of mundane chores from their calendar. Operating at these tiers puts a portfolio in the top percentiles. The focus is zoomed out on why assets move and what leverage they provide, rather than the daily noise of what things cost. Reaching the final threshold brings you to Tier 5, the freedom architecture. At this stage, your execution parameters operate outside the standard retail economic grid. The metric defining this apex floor is the application of opportunity cost math. Every potential obligation is measured by its mental, emotional, and energetic cost. Operators here treat their finite human attention as liquid dry powder. They know that every time they say yes to an unoptimized obligation, they are saying no to high-leverage rest. They pay a premium to avoid logistical stress because that trade-off generates the neurological space required to underwrite high-value ideas. At the apex tour, success is measured by how little you have to compromise to live well. Sourcing these cognitive metrics yields 0 return on your balance sheet without real-world execution to build structural assets. This decision tree shows 2 tactical paths to allocate your resources today based on your current liquid capital baseline. If you operate with under $100,000 in liquid reserves, you enter the passive compounding pipeline. You maximize your active income efficiency and automate your excess salary into low-cost market index funds. If your liquid baseline is near 0, you must execute the time leverage framework. You trade your uncompensated hours to master a high-income technical skill, using that capability to build scalable digital assets that generate cash flow. You can remain a defensive spectator, micro-checking prices and hoarding cash, Or you can commit to engineering an exponential asset machine. Hit the subscribe button and activate your notifications. To lock in your position on the grid, type the word results in the comment section below. Protecting your systems and refining your internal firmware provides the structural basis for gaining control over your time. We will see you back here for the next masterclass. Until then, keep building.